So what is the retirement age for a 401k? Well, is it so cut and dry? Yes and no. 59 and a half is the retirement age, but there's more that you should know. Tune in right now. All right, so what is the retirement age for a 401k? Like, what is the suggested age versus what's the age most people use? And by the way, did you know there's an age when you have to take money out of it? Well, I want to talk about that in this video today and whether a 401k may or may not be in your best interest to use after all. So the 401k age, the retirement age for a 401k, or the time to use it, is usually if you're going to retire anytime from the year of 59 and a half onward. I just tell people if you're over the age of 60, you plan to retire, that's what a 401k is for. Why the government picked 59 and a half, or the IRS picked that number, I have no clue. I think they just like complexity. It just adds to their 70,000 plus page, so-called IRS tax law, right? But they chose 59 and a half as being that age. Now remember this, if you have a 401k and you try to access money before the age of 59 and a half, they will slap you with a 10% penalty plus income taxes on top of it. So they really try to incentivize you to not touch that money early. Now, I will tell you this as a little bonus. And I just had a client, this happened recently, if you get laid off from a job, maybe you're in between jobs and you have this 401k, and you're not immediately working at another job, you could apply the rule of 55, which means you could access that money at age 55 without the penalty. But just be aware, you have to make sure you meet certain criteria, certain requirements. You just have to be in between jobs for that to work. That was great for us because guess what? She didn't want to have that 401k anymore. And I'll explain why later in this video about what she did that was better than just doing the 401k. So anyways, if you have the 401k plan, the typical age is 59 and a half. Can you access it for different things? Very rarely, yes. Big financial hardships, like severe financial hardships, is one option, especially if you get laid off or something like that. Another option could be for your first home. It could be part of your down payment. You're only allowed like 10,000 bucks. It's not huge. Same thing for using it for college. You can use it for secondary school, like college. But that's pretty much it, right? Everything is just locked up and locked away till at least age 59 and a half. So if you're gonna use a 401k, just remember, this is something that you should be planning to retire only if you're going to be using this beyond your 60s. If you're planning to retire at 60s and beyond, this could be a good vehicle for you. But also understand there's other rules in place too. Besides the fact that there's limitations of how much you can put in, even if you want to put in more, they will stop you at putting in so much. The other rules are like a 72 and a half rule too. If once you hit the age 72, you're actually required to pull money out. So you have to pull money out at a certain percentage of it each year once you hit the age of 72. If you don't, they will slap you with a 50% penalty. That's 50, a 50% penalty if you try to access that money or if you don't pull out a certain amount of money. So whatever you're supposed to pull out that year, say that the percentage required to pull out $10,000 that year, but you didn't, they will penalize you a $5,000 penalty you pay to the Uncle Sam, not to yourself. So they will penalize you 50% of whatever you were supposed to pull out that year. So they make sure that you don't just defer taxes in the future forever. You have to take it out now. Remember this too, when you put into a 401k, unless it's a Roth 401k, that's a little bit different, but a 401k, they don't tax you in the beginning, which means they do tax you on the back end, so you will be taxed later on. So you cannot defer this forever. Also understand this too, some people talk about stretch IRAs, they're like, well, what if I die? Could I pass on to my kids? Yes, you can, but they've changed the rules where now you have to your kids have to liquidate it within 10 years, and it has to go somewhere. So you cannot stretch on and not pay tax forever. The government, Uncle Sam, wants you, and they want your tax money right away or as soon as possible. So just be aware, there's a lot of little nuances, a lot of different laws that are in place to make sure that you have to get money out of that 401k. Now, what if you want to retire sooner than age 59 and a half or 60 or whatever it might be? What if you're saying, well, I want to retire at 55, or I want to retire at 50, or in my 40s or 30s, I want to be financially independent, retire early. Well, I keep stuffing money in my 401k. Well, the answer might be stop. Maybe you want to consider stopping. Why would you put money into something that you can't touch when you actually want to use it? That's the big debate. We're seeing more and more of our clients come to us saying, wait a minute, why am I stuffing this 401k when I could actually have possibility of financial freedom sooner? Well, then this thing would just keep me stuck. Like I'll have to keep working until I'm in my 60s. And you're right. That's very much the case. Oh, by the way, just another thing about 401k that beyond just the retirement age of 401k, understand too that most 401k plans underperform the market. They do worse than the stock market. This means that even if you get the match, and by the way, the match isn't as big of a return when you stretch it out long term, it might only add an extra 2 or 3% a year, but many of those funds do about 2 or 3% a year worse than the stock market. So even though you get the match just makes up for the bad fund performance that you have as your options in your 401k. So that's another reason why I tell people, even if you get a match, that free money, as they like to call it, guess what? It's not even really free because you just go into something bad. You could probably invest on your own, have more control, maybe not even have to worry about the 59.5 rule, and still make just as much, if not more, than if you got the match from your employer. I'll also add this too. If you're a business owner and you're paying your own match, that's even worse because then you don't get any real benefit from it. You're just delaying your taxes to a future date when you may not have the business to write off all your taxes, and then you go to a future date where you might have higher taxes. So why would I do that? So that's another thing to consider too. So just understand, it's not that 401k is always bad, but a lot of times 401ks may not be the best vehicle to use for your goals, especially if you want financial freedom sooner than in your 60s. And that's where we come to other stuff. Many of our clients will do things like infinite banking, at least a place to store their money temporarily, make a better return than 0.nothing% at their bank, but they can also make sometimes like 5, 6+% returns tax-free inside that account. But we don't have it stop there because I'll tell you, that won't make you financially free. I can guarantee it. But what can make you free is when you use that money instead to go invest in other things. I personally like things that are cash flowing, passive income type of investments. Things that are often backed by real assets like real estate. I love those kind of assets. Why? Because it can pay me now. It will give you an example. I mentioned that woman where she had that money, that was tied up in her 401k for several years. She got laid off recently. And when she got laid off, even though she was a little bit bummed, both of us were a little bit excited too, because this now unlocked that money. Because you just know when you work for an employer with a 401k, you can't get that money out. Yeah, you can borrow up to 50% or 50,000, whichever's less, you can borrow out of it. But for the most part, you can't touch that money. It's stuck there until you either change jobs or quit or get fired. Neither of them I'm really a big fan of, at least not on purpose. Accidental is another thing, right? In her case, she was laid off. They gave her a little bit of a severance, which helped, but now she had this money. It bought us some time, and it had about $250,000. So now we're looking at this like, what if we put this money over here? Here's one fund that pays you 12% a year, 1% a month. If she only did $100,000 there, that pays her $1,000 a month. The other $150,000, she might split. She might buy some rental properties. She's also thinking about doing some other things like lending her money short term to other investors, which might pay 10, 11, or 12% a year on her money as well. And so now, at minimum, her $250,000 can now pay her roughly about $25,000 to $30,000 a year. The cool thing is too, she's also looking at selling a property. She's saying, you know what, I think I want to finally do what you asked me to do a few years ago, Chris. I think I want to sell that property and get the equity out. So we can get the equity out of that property. That gives us more money to invest, another few $100,000. We can then invest to make maybe a few $1,000s of extra a month. I told her, I said, listen, between these two things, even though she was making rental income on that one property, between these two strategies, we might be able to increase her passive income to over $4,000 a month already. Now, will that help her when she's looking for a new job and transitioning? Absolutely. That's going to help her a lot. It's also getting her pretty close, not quite to where she needs to be financially independent, but getting her there. And just so you know, she just barely turned 55. Just barely. And of course, the whole reason she reached out to us a few years ago is because she knew that her 401k, which had about $250,000 in it, she said, I know this is not going to be nearly enough. I don't know if I can count on the stock market or throwing in all the money I can to ever make this work, which is why we started changing her strategy to create passive income. That has been proven to work time and time again, not just for me, but for many, many of our clients as well. All right, so what is that retirement age for 401k? It is 59.5, but really into your 60s is when it works, in 70s and so on. But just remember, there's a lot of little rules that you gotta abide by to make sure that it works well. But again, if you wanna retire sooner than 59.5, if you're looking at that age saying, well, I want options earlier, then here's what I recommend. Go to moneyripples.com. There's a passive income calculator that you can actually fill out. I would fill out completely and as accurately as you can. And just so you know, when it says old 401k, it's the old 401k, not the current one, right? The old one that maybe you've got from before. Now, if you don't have one, don't put it in there. But we ask for things like how much savings do you have sitting around right now in different accounts. It could even be life insurance. By the way, we have tons of people that have life insurance they didn't know they could use to invest to make cash flow. We got people that have, they might have rentals, but the rentals may not be paying them enough. I had one guy that had $700,000 of equity, but his rental was only paying him $200 a month. We had him sell that rental and then take the cash, go buy a bunch of other properties out in the southeast because he was living on the west coast where it was expensive, bought cheaper properties out east, made all this extra rent, and just a few years later, it's now paying him $8,000 a month. Not $200 a month like he was doing, $8,000 a month. That's almost $100,000 a year, guys, that he's able to make off those properties. So throw the numbers in that passive income calculator It will give you a number to see how much passive income you could potentially create in the next 12 months. Try that now at moneyripples.com.